continues to improve. 6 years ago, our external debt to GDP ratio was around 70%. As of March 2010, this ratio was down to 33%. The long-dated maturity structure of our foreign currency debt helps limit rollover and foreign exchange risks. The country's debt service burden as a percent of GDP, which had previously hovered around 10% between 2001 and 2003, eased to 6% as of March 2010. International reserves have climbed to new highs, providing strong coverage for both imports and short-term external debt. As of end July 2010, the GIR stood at a preliminary figure of 48.6 billion US dollars. At this level, the GIR can cover 9 months of imports and is equivalent to 9.3 times the country's short-term external debt based on original maturity and 5.1 times based on residual maturity, thus providing a strong cushion against external shocks. As a result of the strong external liquidity position, the Philippine peso has remained broadly stable. The trends in the real effective exchange rate show that the peso has generally maintained its international competitiveness over the last 10 years, using different measures of real effective exchange rates. And you will see that in the chart. The endpoints, the beginning and at the end, show that the levels are about the same. With generally lower inflation rates, the Philippine peso has accommodated some appreciation, but without undermining external price competitiveness. Third, on financial sector policy, the BSP has put in place critical reforms geared toward maintaining a healthy banking system. The package of reforms includes the disposal of banks' bad assets, the promotion of good corporate governance and transparency practices, and the upgrading of risk management standards. As a result, we have today an efficient, sound, and competitive financial system. These critical reforms have been successful in steadily expanding and strengthening the banking system. Indicators of the health of the banking system contribute to post-favorable readings, with asset levels and bank earnings continuing to improve. The capital adequacy ratio remained high at 16%, and non-performing loans also remained generally low at less than 4% of total loans. The favorable performance of the domestic financial markets reflects the upturn in the country's economic prospects. Thus, despite global market volatility following sovereign debt concerns in Europe and uncertainties regarding the depth and breadth of the global economic recovery, the spillovers on our domestic financial markets have been limited. With continued improvements in domestic economic conditions and a broadly favorable global outlook, we foresee a firmer growth path for the Philippine economy in 2010. Inflation is expected to stay within the target range of 3.5 to 5.5% this year. The outlook for the balance of payments position and the GIR level continues to be favorable, with the current account projected to remain in surplus. While we expect the economy to continue to perform strongly, we remain conscious of the risks and challenges that lie ahead. First is the multi-speed recovery across the globe. Growth in emerging countries is outpacing growth in the advanced economies. Given global interdependencies and linkages, this could result in subpar global growth over the medium term, what some people call the new normal. Second, the potential heavy inflow of capital into the country as risk appetites perk up